Another year where the grain producers are facing more uncertainty as farmers ready for the next growing season. From weather to the geopolitics, sticky inflation and rising rates, the USDA released its March Prospective Plantings report, and the big takeaway was that farmers intend to plant significantly more corn acres in 2023. Scott, what was the biggest takeaway for you?
Well, I think that the story of the day was wheat. We saw a big increase in wheat seedings, over 4 million acres. And what really jumped out at me was how much of that was in the Eastern Corn Belt, over 1 million acres of double cropped wheat.
Boy, it is a lot, and it shows how the USDA program of finally offering the second crop to be insured is having an impact. Kent, what did you see, or what did you think?
Well, from my perspective, the stocks portion of that report did show that farmers still own a good chunk of crop from last year, particularly in corn. On-farm stored corn in Illinois is still very high. We've had inverses in the market. The market's kind of telling us that we should be selling it, but we haven't seen the market rally. So farmers still have corn in the bin. If we still have a decent amount of the 22 crop left to sell, they likely haven't got much of a start on the 23 crop. And at some point they have to sell that, and it can put pressure on the market if we all want to try to sell at the same time.
Oh, no doubt. Scott, weather is always a perennial concern for farmers. However, as we're seeing an end to La Nina, how does that give us a potential for the new El Nino pattern, and how does that affect U.S. producers, or is this just kind of a wait and see?
For me, it's a wait and see. I don't think the evidence is very compelling that tells us a lot about what's going to happen to our summer growing season weather here in the U.S. Corn Belt. So it's a big weather uncertainty as usual.
All right, Kent, with weather always a sudden event, how do your clients approach it from a risk management perspective?
We want them to have a balanced approach and a flexible marketing plan. So we want to protect the downside that if this weather going forward is decent and we get a good crop planted and get all the acres planted, we want to be protected of if this market decides it wants to work lower. But if we do have weather problems, we want to have flexibility and being able to take advantage of higher markets as well. So that's where the options come into play. Having a balanced portfolio here to manage risk, keeping flexibility in it is key.
Oh, I agree on the volatility. It's going to be that kind of summer, I fear. I'm going to shift the discussion a little bit to input costs. Scott, crop prices are high, but so are input costs. With supply chains now starting to ease, can we expect some of the fertilizer and other costs to diminish, or is this going to be what I consider or you consider to be the new normal?
Well, I think the new normal is that there's a correlation between grain prices, particularly corn, and fertilizer and other input costs. And so if grain prices come down, we know we'll see some decline in fertilizer prices, for example. It's kind of, though, the problem for farmers, it's what we call a rockets and feathers situation. When grain prices go up, input costs rocket up, but they're like a feather. They come down a little bit slower as the grain prices decline. So that's a situation that farmers will have to manage. We have seen some nice declines in particularly nitrogen in the recent months, down probably at least 15%. And I think the trends suggest that probably further declines are on the way.
Kent, how are farmers that you're talking to across the Midwest approaching the input situation for not only this year, but also for 2024?
Well, for this year, there were probably more, I would say, that held off on nitrogen this last fall. If the price was already fairly high, there were plenty that took the risk that we would see lower prices in the spring. They just wanted to wait. And as of now, they're being rewarded with that because the price is lower for nitrogen and dry fertilizer for that matter. But I think going forward for 24, you'll see more people looking at those prices this summer already, because we've seen the last couple of years getting it bought early enough has helped ease the pain a little bit. And if they get a price that they feel pretty good with, I think you'll see more producers locking in fertilizer needs as early as this summer for the 24 crop.
So, Scott, China began buying more U.S. corn as prices dipped in February and March. Could we see China buying more U.S. corn, or are they going to shift those purchases to Brazil? What do you think?
I think that answer really depends on what happens with the Brazilian second crop or safrinha corn crop that's being put in the ground or was just recently planted. If they have a big second crop yield this year, I think almost all the sales will go to Brazil and not the US. If production prospects turn out to not be quite as good as expected, then we could see an uptick in business from China to the US. So it's going to really depend on weather down in Brazil.
I'm going to ask you another question, just a little bit, bringing you back to the United States and interest rates. You know, they've been rising an awful lot during the last year. How has this affected land and equipment purchases? Are you seeing any changes in cash rent or leasing of machinery?
I haven't seen much impact yet, I think, on cash rents and machinery, but we are definitely seeing an impact, I believe, in the farmland market itself. I think it is pretty much putting a cap on the incredible surge we've seen in the last 2 years in Corn Belt farmland values. But so far, I won't really see any significant downward pressure, but that's part of a big change like this takes some time to work through the system.
Kent, if you could, banking, I'm going to have a touchy subject for the industry, but does regional banking failures continue to have ripple effects on the ag economy, or has the government intervention really eased any of your concern?
We really haven't seen any changes that I know of on the regional end for the farmer. They're still getting financing as they need it. I think when you couple that question, though, into interest rates, the interest rate calculation needs to come into focus as they go to make a store or sell decision here going forward. Because at current prices for corn and interest rates, they're probably looking at 3.5 cents a month in interest costs. And on soybeans at $15, you're pushing 8 cents a month in interest. So that starts to add up as we go forward and they get more money borrowed. And it will be interesting to see if that affects what they sell and what movement we have this fall of corn and soybeans.
Scott, last question. What is the one indicator that we all should watch in agriculture as we head into the summer?
For me, it's crop conditions ratings for U.S. corn and soybean crops. In particular, if we do get good weather and those condition ratings really start to surge, with the acreage base we have, we're already in a stock building environment that you could really see a downdraft in grain prices this summer if those ratings show that production prospects are really good.
I agree 100% with what Scott says. I think from a shorter term standpoint, we have to watch planting progress. Does the Delta area come up a little wet and they are a little slow getting stuff planted? As of now, they are not, but can that change? That was one area where we were going to see some corn acreage expansion versus last year in that prospective plantings report. The other area is going to be in the Dakotas and Minnesota with the snow that has to melt there yet. How fast do they warm up to get that to melt? Does it cause flooding? How fast can the soil temperatures warm up to get that planted? I think those are all key. And so they have to monitor that and remain diligent in keeping that in focus.